Hello, everyone. Thank you so much for joining this session. It's actually really a great pleasure for me to participate in this very valuable event. Today, I'm going to talk about the paper, which is the joint work with Alfred Lihar. We are looking at private settlement in blockchain systems, and we try to document some facts that settlement is not provided for all the users uh, based on their different types. I mean, everyone may think that settlement is similar for all the users who are participating in blockchain work for transfer, for having the transactions and stuff like that. And we have evidence and documented that settlement is heterogeneous and it's not similar for users. So for this talk, here is the overview and the items which I want to share with you. The first one is our research focus. Then I will talk about the data and architecture because the great majority of data that we are looking and gathering is not public. It's kind of based on the microstructure level data, and we developed and implemented different programs for gathering data, organizing, and I will describe the architecture that we use for this mean. We have a toy model, actually not a very complicated model, trying to showing how things work and what is our expectation about the behavior of the miners and users in private settlements. Our paper is mainly empirical. We have a hypothesis and try to show how these findings can support our hypothesis. And also in the last part, I'm talking about some robustness tests. I can say that they are kind of event studies. I'm still thinking how it's better to be kind of presented in the paper because it's at least 5 event studies to show how private settlement work. And we can at the same time look at them like robustness tests for our findings. Let's start with the focus of our research. As you know, in traditional financial market, we, we have a central authority who do the settlement. By settlement, we mean that it clears the positions, change the money between the debtors and the creditors, and kind of clearing the daily trades. And also another big feature in traditional financial market is the regulated fee. All transactions that are happening in the stock market, they have regulated fee. And also a user which want to do a transaction will should pay the fee based on the regulation and not by proposing a fee or offering a fee. And the other thing is that we usually have one trustee or settlement agent, which all the parties can agree upon this settlement practice in the traditional financial market. But when we look at the blockchain systems, we know that it's unregulated and decentralized. But how it works in terms of settlements, when user can offer a fee to the settlement agents, what will happen in the market? We are kind of interested to know more about what will happen if we have multiple settlement agents. At the same time, users can offer fee to this settlement body. And the interesting point is that the settlement agents have discretion in transaction selection. So we have the sense and we have evidence that there is kind of price discrimination or discrimination in providing the service to the settlement, uh, those who needs settlement service. And the miners play a very crucial role here. We look at miners as clearinghouse. They pick transactions from the memory pool, which is uh, an architecture like a queue that transactions are waiting based on the fee that they offer to the settlement agents. They will be reordered. And then the miner have discretion to select transactions. Not It's not kind of obliged to select transactions in order of arrival or stuff like that. And by adding them to a new block, the miner can provide the settlement service. So in this context, we define the settlement picking a transactions from the waiting list and add this transaction to the block and persist it forever. And this is the service which users are offering fee for receiving that. To be more specific, in this slide, I'm trying to show what's the Bitcoin protocol work in general. I'm sure that you know the Bitcoin protocol and it's very well known, but in our context, we want to highlight that we have two types of transactions. The normal transactions are those who are obeying the general path of the Bitcoin protocol, and but the private transactions are those who are kind of bypassing the Bitcoin protocol, and the users are sending transactions directly to a specific miner without even waiting in a queue. For example, if I want to send 10 Bitcoin to Near, I should submit these transactions in a memory pool. I should set my wallet address as a sender and his wallet address as a receiver. And then waiting for a memory pool, the miners will kind of participate in a competitive uh, game for finding a new hash. And a miner which could win the next block can select transactions from the waiting pool and add it to the block. And this is the procedure that everyone agree upon on Bitcoin protocol. But we found that almost 5.88% of transactions are bypassing the Bitcoin protocols, and users send their transactions to specific miners to communicate directly with the miners, and then if the miner can win the block, these transactions will be added without even waiting or kind of waiting in a memory pool. And we want to see what's the effect of this type of transactions and behavior in settlement market, in blockchain system in general. We want to see if this is a big effect, how users will be affected, and also document that this exists, because it's not that well known or well circulated that this is another procedure.
Can I ask a question?
Yeah, sure.
So, what is the difference between thinking about this structure and thinking about the difference between you buy stocks directly from the stock market or if you buy them via broker? So can we think about buying directly from the stock market as the private transaction, and when you buy via Robinhood, it's pretty much, or other broker account, it's kind of buying via memory pool?
Yeah, thank you. That's a very good question. Actually, the viewpoint here is mainly on settlement procedures. It's not on, for example, transactions. In an example which you mentioned, and we have it in the stock exchange, it's mainly related to trade market. We are looking at settlement market. Even if you buy something directly from the stock and not from the brokerage houses, order of settlement, the fee, and all the procedures are regulated and same for all the users based on when you did this procedure. And most of the time it's kind of real time. But here we want to show that although users transactions are kind of will be persisted at the block at the end of the day, but the procedure for doing the settlement is not same for everyone. So I may arrive later with a kind of higher fee, but the miner do not select my transaction, and it's this kind of questioning how the fairness will be affected in the settlement market. As we said, we have some evidence of bypassing the public trading venue in traditional financial market, which you mentioned that. We call it like dark pools or ECNs in the stock market, and it's very common even in United States. I think it was 40% of the trades recently. But what's different between the two is that in the stock markets, bypassing the trading venue is usually related to reducing the transaction cost and also lessen the price impact because it's mainly about the huge trades that may affect the price in the market. But here, the settlement procedure in blockchain systems doesn't affect the transactions or the price. And this is kind of different from this perspective. The other thing which I would like to mention is that anecdotal evidence is consistent with what we think about private transaction channels. There are some sort of services, interestingly, freely available even on GitHub that allows users to interact directly with the miner with an API. For example, Bitcoin SV provided some services like that, and we documented users' interest to interact with miners. And we want to see why it should be interesting for the users. What are the gains and what are the benefits there? Let's just briefly relating our field of research to the literature. Uh, I can say that our work is mainly related to the literature talking about the settlement in unregulated markets and the papers who are trying to provide some viewpoints on regulations and supervision in even unregulated and decentralized markets. There are very rich literature in terms of how fee affects the blockchain systems. For example, at the very beginning, the fee is not that important, but we all know that after each halving, the block reward will be decreased, and in a long run the only strategic item that miners are will compete and the users kind of participate is fee, because after a certain number of blocks and the halvings we just have fee as a strategic income for the miners. Another types of literature which Alfred working currently with Christine on that is about miner collusions. It means that miners can manage the capacity of the blockchains in order to kind of having some sort of a strategic collusion with each other, trying to show that, for example, as an example, trying to show that the market is really congested. They do not, for example, accept transactions and confirm transaction and leave the blocks still empty to raise the fee. And because the users can modify their fee, or if they see they are waiting for a long period of time, they can improve it. So the miners can behave strategically in this regard. Another strand of literature, which I highlighted it in light gray, is about miner extractable value. It's very well done in Ethereum. I can both say it's related to our field and it's not. Because in Ethereum, the order of transactions in the block matters a lot, and miners have incentives to kind of reorder the transactions to extract more value. But in Bitcoin, because we do not have any type of executions or ordering, minor extractable value does not happen here. And our findings is kind of counter wise comparing to Ethereum. In Ethereum, they show that if users who want to have some sort of private transactions with the miners and private communication, they have willingness to pay higher fee per rate. But we document that in Bitcoin, users are paying lower fee per rate, and we will see why. So our contribution could be trying to analyzing the contractual structure in our regulated market. We document that this bypassing behavior affect the competitive settlement markets. So users who may be frequent pay different price comparing to the infrequent users when they want to enter the settlement. Let's look at the architecture and, for example, 1 year of the data here. In order to detect private transactions, we need to have both transactions that are waiting in a memory pool on the right-hand side. And also, we need to have transactions that are confirmed in the left-hand side. We are receiving data from 2 Bitcoin nodes. For the mempool, it's almost every 1 minute, and for the blockchain, every 10 minutes, we receive the blocks and we create 2 data sets. We found transactions that are confirmed in the blockchain, but they were never waiting in a waiting pool. So those are transactions who has been sent directly to the miners. For example, in 2021, there is 52,000 blocks, and from 93 million transactions that were waiting in a mempool, the private transactions is 5 million almost. So we have 5 million transactions that are sent to the miners directly, or 27 pool. But the hardship in this detection is mixers, because the mixers try to hide the procedure of the real sender of the transactions by gathering all transaction of, for example, different parties together and then submitting them in several steps to the pool. We try to implement a program for detecting the mixed transactions based on well-known algorithms, but it's almost kind of not 100%, because if the mixer's algorithm will be detected, then it's not a mixer anymore and they cannot receive fee. We did our best to implement the procedure and also the union of all well-known mixed transactions, which is described in the paper in the appendix section. And also we excluded the minor transactions, because miners have some sort of transactions with themselves, with their related pools, because they sometimes trying to share their what they could gathered by confirmation procedure and their portion of participation. We exclude the minor transactions because we believe that in those transactions, maybe they want to really communicate directly with each other and they don't want to pay for mining their own transactions. Now let's take a look at our very first observations. We look at transaction fee per rate as a measure which shows kind of how this transaction is valuable for a miner to insert it in a block, because each block has limited space and the miners like to take transactions which has higher fee but with lower size in a block so they can maximize their profit. We use a dummy variable for transactions who were private, those transactions who already bypassed the procedure. And we found that the transaction fee per wait for private ones are lower comparing to the normal ones. So it shows that those users who are communicating with miners directly are receiving a discounted settlement service. We do not know why. We will see it in future slides, but this kind of incentivize us to dig into this procedure more and learn more about that. The other observation which was interesting and make us think more was that all miners are not engaged similarly in these mining private transactions. We found that miners who are smaller have more incentives to confirm private transactions, but miners who have a greater size or they are larger or they have greater market share based on the number of blocks that already mined by them, they have lower incentives. And these two observations kind of provided us with the basic understanding of there is kind of some sort of heterogeneity in the settlement market comparing normal transactions and normal and private transactions. Just to be able to showing what's happening there, we utilized a toy model because the intuition behind this model is that the miners are not sure about their fee revenue because they are not sure if they are winning the next block and they can collect the fee and the reward while they are trying to solve the hash problem and they face some sort of costs. So the miners have motives for risk sharings, and the smaller miners can face this risk more severely. So the risk is greater for smaller miners because they already had lower computation power, so they have less chance to find the next block. So this is kind of similar to what we observed till now. And if the miner can have a private contract with a specific user, then this miner can secure its expected fee revenue in the future because that miner can know if I'm going to, for example, find the next block, at least I will have some fixed revenue for mining those transactions. And in this model, we try to compare a regular miner with a miner who has a kind of settlement agreement with a user for private transaction, and we want to see what's the difference between these two. Let me go to the next slide. So if we look at the size of the miner based on the number of blocks that a miner wants to have already mined and show it with V, in each period, the miner can face distress and loss because she doesn't know if the revenue is high or low in the next period. So the probability of financial distress for that miner is based on the number of blocks that miner mine, and also the possibility of financial distress in each round, which can be 1 or 0, for example. So the probability is 1/2 to the power of v. And if we simply compare the expected profit of miner with size V, who is going to take transactions from the mempool to collect the fee of those transactions, the profit for the regular miner compared to the miner who signed a contract with fixed revenue C is based on the contract revenue and the number of blocks. And if we try to find an indifference curve based on the fixed revenue, we find that as the size of the miner increases, the fixed fee revenue increases at first, but it will not change after a specific size of the miner. And this is again compatible with our findings that miners are not equally involved in mining private transactions. Those who are smaller has greater incentives to mine private transaction. And in this simple formula, if v goes to infinity, we will see that we can have a fixed kind of profit based on the fee. And we will show these findings in the data as well in the future slides.
Sorry,
Another,
can I ask a
yeah,
quick question? What, how should we think about these miner size? Like, what determines a miner to be like a bigger size compared to a smaller size?
Yeah, it's about the number of blocks that miner mined in the previous period. Those who
Okay.
mined a greater number of blocks has a greater market share.
And oh, I see. Got it. Oh, thank you.
No.
So I have a question. I just want to see
Sure.
that I may be getting to. If you think about the private transaction as you pay to a miner in advance for executing your transaction, but the agreement is that I am aware that it's depend on the probability that the miner wins the computation.
Yeah.
So I know that it can take few times. It's not going to be necessarily this block, so it can be even tomorrow.
Yeah, exactly.
So I kind of pay a less fee, but also as a trader, like the trade-off is that the probability of the transaction being executed is lower.
Yeah, exactly. That's a valid point. And this is how users who are contracting with private miners or the users who want to do private transactions communicating with smaller miners because they want to receive discounted service, but they do not know how much they should wait. This is one of the interpretations. You got it really well. One of our interpretation about this behavior, yes.
Okay, yeah, makes sense. Thanks.
Thank you. I think one of the other important facts in studying this behavior was to look at the users instead of looking at the transactions, because transactions are the lowest granularity level that we can look. But if we want to find the behavior, we should be able to kind of classify the users based on their behavior, because the users can have great different number of valid addresses. Based on each valid address, they do some activities. So we implemented the user classification method. This is based on the union find algorithm, which is well-known algorithm in IT. Tries to find the mutual valid addresses from the sender side, because if the sender side has the opportunity or privilege to use some valid address as a sender, the sender should have the key for those addresses. And by implementing this algorithm in a recursive manner, by merging the addresses that were using frequently in different transactions, and then create a group of transactions and valid addresses which were already used together, and do it for several times, we could classify 3 million records of transactions and valid addresses to 59 million users. So with this group of transactions and valid addresses, we then try to find and report some stylized fact on users. We name a user that have at least 10 private transactions in our sample as a private user. We found that out of 59 million users, we have 3 million users who were participated in private transactions, and 55 million users didn't have any type of private transactions. And if you look at the difference between the average fee that private users have paid, we will see that these users have paid almost 20% less fee on average. Their transactions are mined by almost one miner, which shouldn't be in the kind of competitive setup for settlement. Like comparing to the normal ones, because it's kind of random, out of 21 mining pool, a user on average communicated with 9 mining pool because it was random and based on the waiting time. And also we find that private transactions are utilizing this private channel very much. They have the great number of transaction count and the transaction demand. This is the primary findings on what's the difference between private users and normal users in terms of settlement procedure. In order to formalize our empirical analysis, we had a hypothesis that we discussed about that in the previous slide a bit. We think that private users utilize their dedicated communication channels to bypass the protocol because they have a long-term contract with the miner. And if this is so, we checked 5 kind of sub-hypotheses to see if this is valid or not. For example, in terms of average fee, we checked if these users are paying lower average fee with lower variation, because if I have an agreement which is already negotiated with a miner, the fee shouldn't that vary like a normal user, which the fee will be kind of set by the market. We wanted to see how the number of transactions will affect. Our first assumption was that if the bypass channel have already set between two parties, I as a user try to use it as much as I can. So we assume that this bypass channel should be high traffic. The third one is that if I have a long-term agreement with a miner, why should I switch to another miner? So the likelihood to stay with that miner should be higher. So my tendency to switch to another miner shouldn't be that high comparing to the normal ones, because the normals are just sending their transactions to the mempool and wait what happened. We checked this hypothesis, and again for the miner size, we believe that bigger miners are less likely to confirm private transactions. They are more sure about their revenue, and they are less stressed about that. And also maybe they consider their reputation as well. The fifth one is about the regularity of transactions. We found that transactions that are private are spaced out evenly through the time. It means that they are kind of deterministics and free negotiated based on the situation of what's happening there. And for these 5 items, we checked what's happening and what's the difference between private and normal users. For example, for number of transactions, by doing the regression analysis, we find that in general, if a user increases its number of transactions, this user should pay higher fee. But when the private user increases its number of transactions, it pay less fee. And also, for example, in this regression, we look at the fee variation. Increasing the number of transactions decreases the variation of fee per wait, because it highlights the fact that the user is already negotiated the average fee. For the same miner hypothesis, we checked it with probit regression. We calculated the number of distinct miner who mine transactions for each specific user, and we wanted to see what will happen, what's the chance of mining being mined by different miners for private users. And we find that if for private users, increasing the number of distinct miner will decreasing the chance of private ones. So we can interpret it like this: if I'm private user, there is a higher chance for me to be mined by a specific miner, and number of distinct miner have a decreasing effect on my mining experience. For the miner size, we check both the model which we propose, and also in our data, we try to find a lower threshold and an upper threshold for the miners who want to participate in private transactions confirmation. And as we expected, based on the data, we have an upper threshold, which after that, miners having the greater size, they are not involved or they are not interested in mining private transactions. But before that, the miners have incentives to do the private transactions confirmation. And we checked that with regression analysis on private dummy based on private regression as well, which kind of confirm or supports our idea. For checking the regularity of transactions, by regularity we means like this one. The red arrow shows that these transactions are more regular. It means more expected. And by the green ones are kind of a sample for showing that the transactions are not regular or predictable. For checking if transactions of private users are more regular, we utilize a proxy for block creation time, and we check the variation of interval time between two private transactions for each user. And we showed that the standard deviation of this difference, or standard deviation of the timing between the intervals, which are like these ones, is lower for private users. So the private users have tendency to send their transactions regularly, no matter how long it should be, but it's kind of regular. And to make sure if this kind of private...
So I have a question about the previous slide. So here, so the intuition is that these firms or these players that consume these private transactions are looking at this transaction as kind of a regular service. So they have kind of they're doing a regular Bitcoin payments. So let's say let's think about if I own a company and I pay my workers Bitcoin as a salary, so I do it every month. Okay.
Yes.
So instead of every month going to the blockchain and send a transaction to the mempool, I can have a contract with a miner and say to him, every month try to execute my transaction. I will pay lower gas fee, but I'm taking into account that it could be that the transaction will be executed one day before, one day after. It's not guaranteed when, but it will somewhere in the middle. But when I look over the year, it will look that every 1 month I pretty much have a transaction.
Yeah. That's one of the things which we think is compatible with our story. At the moment, we are using the Wallet Explorer API in order to classify the wallet addresses. We find that some of the wallets are related to exchanges, interestingly. Some of them are related to some services that are offered on the web that they guarantee that the level of fee payment and kind of, as you said, for example, the longest period of time that they want to wait, which reminds us like some services who are provided by some boats and things like that. And the other thing which is very similar to what you mentioned and it was interesting is a loan payment as well, because it has some nature of regular transactions, but it's not time sensitive, as you said. You have a spectrum of timeline, but you are not that kind of sharp on when it should be processed. So that user may prefer to pay lower fee, but give some flexibility of on the timing. That was our understanding as well. But we are still trying to classify and connect our data with Wallet Explorer web services and see what we can learn more about these users. Yeah, we're still working on that aspect.
Interesting.
Thank you. And for the random, in order to see if the private dummy is informative and significant, we check the effect of kind of submitting a private transactions by private dummy on fee per weight, and we found that even in a random sample, this kind of dummy that we define is important and have valuable information. One of the event studies, which at the moment I added it to the paper in robustness check, is about the Xinjiang event, which happened in China for province, that because of severe flood, several coal mining sites crashed in that province, and then the government decided to shut down and announce the blackout between 17th for 17th and 18th of April 2021. And why this province is important? Because lots of Bitcoin miners has already physically established there in order to receive the subsidized electricity. And we wanted to see how this effect, which was unexpected, were kind of affected the market and also affected the users, how it affected the Bitcoin. As you see in this chart, which the blue line shows actually a very big jump of the market, because a great portion, almost 20% of capacity of miners who were working in Bitcoin were shut down because of the blackouts. And the fee jumped from $60 to $52 in that specific date and week. And we wanted to see how private users who were already communicated with those miners affected based on this event. We found that the private users, like other users, are paying higher fee in order to kind of secure their priority to be confirmed and to be mined by the miner in that congestion and also in the peak of fee, but they are still paying the discounted fee. As you see, after this event, we check it with a dummy for the date. We see that the average fee per weight increased, but the private users are still paying less. So it seems that they are still interested to kind of receive a discounted fee based on their negotiation, but because of the severity of the condition, they kind of increased their fee payment a bit in that period of time. So it's still some sort of different between receiving the services of fee payment for private and normal users. The third robustness test which we designed was to look at if private user even switch between the miners, and if a user switch, is that switch toward lower fee per rate prepayment or no? For example, I brought here for you a random user, for example, which is user ID 19, which is a private user actually. We find that through the time, this user switched from one miner. For example, first it was working with Sigma pool from block 665541 to this block. Then it switched to another miner, and this is the trend that this user is going to pay the fee per rate. So we found that the private user may switch to another miner in order to decrease the fee per rate, and it's never switched to miner for paying the higher fee per rate. Is not rational. And in general, we found that 10% of private users may switch, but they are not communicating with more than one miner at a time. So we see no overlap between the block height or the number of blocks that they were communicating with the miner. And we checked that with a regression analysis. We defined a variable, we called it a user profit. And we define a profit based on if I'm switching from miner A to miner B, how much I'm going to pay less. And if this switch was provide me with a profit of paying less, we add all these profits together and consider it as a total switching profit per user. And we wanted to see how miner market share or miner size will affect the user profit, which is kind of supporting the idea that miners which a smaller size have more interest, or from the other side we find that users have more incentives to communicate, to switch, and also to change their settlement services based on the agreement, looking forward to miners with a smaller market share, because we can say that the users can have better negotiation power, have more advantages for communicating with the smaller miners. And we found that if the size of the miner increases, the user profit decrease. So users have tendency to switch to a smaller miners for doing the private transactions. And the last one is actually, I added this to the paper in the previous week. I was thinking to kind of provide a setup for causal study in this regard. And you please let me know your idea, because I really want to work more on this setup. I was thinking as looking at the confirmation procedure as a random cutoff for each block based on the average fee per rate, because no miner and no users, none of them are sure about if they are receiving the confirmation or not. But for each block, if we look at the confirmed, it's not writing. If we, for example, having the confirmed blocks, and at the same time we have waiting transactions in each period of time, for each blocks, I calculated the fee range, the lowest fee per rate and the highest fee per rate in each block, and tried to find transactions that are waiting and still fit in this range. So if a rational miner wants to select transactions for mining, that miner may choose a transaction with higher fee per rate. But I observed that the miner will select transactions which is private and has lower fee per weight when there is still transactions with higher fee per weight waiting there. And this is the fact which provide me with the sense that it's compatible with the idea that this settlement service is based on a long-term agreement and it's not based on the one-time decision. Because in a one-time decision, the miner would select transaction with higher fee. Why she should decrease its kind of fee revenue? And I checked that with regression analysis, and I found that when and treated in this context means kind of receiving the left hand side, not waiting on the right. I found that if a user, if a miner select the private transactions, there are at least other transactions that are waiting and have higher fee per weight, but the miner decide to select its transactions with lower fee per weight, which is not rational in a one-time decision. So this behavior should be based on a long-term agreement or long-term incentives, not just a first-time procedure.
But the question is how the contract between the miners and the private the guys that want the private settlement works, in the sense that what kind of what is the way that makes the miners not deviate? Because in this case you can say, okay, in a one-shot game the miner should deviate and defect the private settlement agreement and execute this transaction. So the question is how if we can look on the contract how it works. Does they pay them in advance? It works.
Actually, that's a very good question. Actually, here, the miner is not kind of defecting in terms of its private transactions. I mean, or private contract. It's kind of against its own profit, because the miner is selecting a private transactions which has lower fee per weight, while she could she could have selected those transactions who are waiting and have higher fee per weight.
Yeah. I agree with this logic, but I'm just saying that in order that it's going to hold, so something in the mechanism of how the private trader pays for the miner should work in a way that there is no incentive to defect.
I see your point. You are how the miner can be sure that in the long run it would be kind of in profit.
Exactly.
By kind of doing against its own profit in the short run. That's a very good question. I haven't thought about that, to be honest.
Yeah, I'm guess that there is a very interesting way that they have kind of like maybe they have maybe a smart contract or a way to enforce this agreement. I see your point that in the long run it's profitable.
But how the miner can predict it, for example,
how
many
exactly.
That's a very nice viewpoint. I actually write it down to think more about that. Thank you for raising this question. And to conclude, based on the timing, I hope I could be on time. Actually, in this to wrap up, we in this working paper we showed that settlement deviate from the perfectly competitive market for 5% of the users, and these users are paying on average 20% lower fee. And this lower fee is actually, I should mention that it's on Bitcoin. And if we currently we are trying to add the US dollar value to our data set as well. And I think that based on the variation of the price of the Bitcoin, this is a very kind of a big amount that these users are paying less. We think that our evidence is consistent with existence of bulk pricing or private settlement. And as I said, we should dig more into who are the users and what are the incentives for the miners. And as you said, how the miners can be sure in terms of their profit in the long term, in the long run. And we hope that this research helps to better understand what's the connection between on-chain activity and the market competitiveness. And we raise the question or kind of remark that the market is not fully decentralized in settlement part, because we have witnessed that some miners and users who have more demand are contracting around the settlement procedure. And thank you so much for joining the session and also listening, and your very valuable viewpoint. I really enjoyed that. Thank you.